Have you looked at the price of gold lately? It hasn't just risen, it's gone vertical. After a decade of doing almost nothing, gold has skyrocketed to nearly 10 times its 1990 value. But before you rush out to buy, you need to ask yourself one question. Is this a sustainable breakout, or are we about to see a repeat of the 2012 gold price crash, where investors lost a fortune?
Today, we're stripping away the mystical allure of gold. We aren't looking at ancient secrets. Instead, we're looking at cold, hard data. Is gold really a safe haven for your portfolio? Or is it just a high-stakes gamble wrapped in a shiny package?
Just a note before we start. This video is for educational purposes only and is not financial advice. All investing involves risk, so always consult a professional before making investment decisions, as we cannot take liability for any financial losses.
For thousands of years, gold has been the ultimate insurance policy. In the 1940s, a handful of gold coins was often the literal difference between life and death for refugees fleeing conflict. It was the only asset that couldn't be switched off or devalued by a printing press. Historically, if you didn't have gold, you were at the mercy of the government.
But here's the thing. We don't live in the age of sale and steam anymore. We live in a world of instant digital trading and alternative assets. Many people treat gold like a magical shield, but in 2026, we have to treat it for what it actually is, just another investment asset with its own unique risks.
Let's look at the 1990 test. If you had invested $100 in gold in 1990, it would be worth about $1,300 today. That sounds great, right? But if you'd put that same $100 into the S&P 500, the top 500 companies in the US, you'd be looking at over $2,000. Even with gold's recent surge, it has been vastly outperformed by equities. Why? Because companies produce products and profits. Gold just sits in a vault.
But what about inflation? Everyone thinks gold is the perfect hedge against a rising cost of living, except that the data says otherwise. Between 1988 and 2000, inflation actually ate away nearly half of gold's purchasing power. Unless gold is in a surge period, it often loses value rapidly over time. It's a lousy long-term store of wealth if you're looking for stability.
Where gold does shine is speculation. When the world panics, gold spikes. But when it falls fast. Unlike the stock market, which usually recovers in a few years, gold can take a decade or even a full generation just to get back to where it started.
And if you think gold is a roller coaster, look at silver. It's like gold on steroids. It moves in the same direction, but with much higher volatility, magnifying both your wins and your losses.
Now, I've been pretty tough on gold, so I've asked our peer reviewer, Pete, to give us the other side. Pete, what are we missing?
Thanks, Kate. Look, the numbers don't lie, but I have three things for you to consider. First, the past doesn't guarantee the future. Just because it crashed in 2012 doesn't necessarily mean it will now. Second, while stocks recovered quickly in 2008, the dot-com crash of 2000 took much longer for investors to break even. And finally, don't ignore that grab bag utility. In a total systemic collapse, you can't buy bread with a digital stock certificate. Gold is the ultimate last-ditch insurance policy.
Thanks, Pete. The takeaway is simple. Are you buying gold for price growth, or are you buying insurance you hope you never have to use? In the world of finance, emotions are expensive. If you're buying because of FOMO or a feeling, it could cost you dearly.
We've covered a lot today, but this is only one of 30 critical topics we've analyzed. If you want to fast-track your learning, we've put everything into our book, available now on Amazon Print or Kindle. Click the link in the description to grab your copy, and I'll see you in the next videos, which will be about the 2000 dot-com market crash.